Alibaba just reported their Q4 and year-end results. And I mean, of course, the market didn't take it too well, down 6% today. You have to understand this is amid tensions between Russia and Ukraine. Russia actually just invaded Ukraine today, so the overall markets are relatively down. But yeah, I mean, at one point this started out at $100, and now it's $103. So it's a volatile ride with Alibaba. Alibaba is my largest holding, and just like Charlie Munger is doing, I will be adding on the dip. P ratio of 14 right now. This is still a behemoth of a company. I believe in this company long term, so we're going to go in depth into their quarterly results, why it's still my biggest holding, and where I expect Alibaba to go over the coming years. So stay tuned, and let's see if this being down stock could be a bargain buy for you. So welcome back to another video. My name is Adam. On this channel I talk about finances, stocks, and making money. Right now we are not making money in the markets at all. I mean, year to date you're looking at a 14% decrease on Alibaba. I mean, that's like kind of like the Nasdaq. The Nasdaq is down by about like 17% year to date. So it's actually not doing too bad compared to the Nasdaq, a tech heavy index. But I mean, over the past year, the Nasdaq is not down 60%, but the Alibaba is down 60%. Over the past 5 years, since actually going public, Alibaba's only up by 10%, even though they IPO'd in 2014. Okay, over the past 5 years, it's basically just break even. And I mean, yeah, from highs of $300, it's down by 66%. You'd expect this to happen with a penny stock, but amid growing concerns of slowing growth, let's see if we can find a gem, and let's see if there are actually any meaningful reasons behind this 60-70% decline in Alibaba. And I mean, right now, this stock, even though it's only growing by 10% revenue year over year, is still a steal at a P ratio of 14, and we'll talk about why. So slowest ever revenue growth and misses expectations. So the company, the 10% revenue growth is the slowest quarterly year-over-year growth rate for the company since its 24 U.S. listing. Alibaba has been facing macroeconomic headwinds and increased competition in China, which have weighed on the company's business, and the shares were down more than 5% on Thursday. Honestly, I don't even think this is necessarily really accurate. Okay, sure, there's been increasing growing competition since the start, since Alibaba's IPO. I mean, of course, the bigger you get, the harder it is to find new revenue streams, but Alibaba is doing just that. And I think it's had a little bit of a setback just because it needed to cut back on some of its leading growth sectors, such as Ant Group. The reason for that being, of course, that the China tech crackdown on Chinese stocks. So this is not necessarily a problem with Alibaba in of itself, but it's a problem with the way that the government is forcing Alibaba to become a lower margin business. However, despite this, I still think that the majority of the sanctions are over. 2021 was incredibly tough, but going forward, I think we'll see higher rates in Alibaba's businesses. I mean, for one, they're expanding internationally at a pretty decent clip. I believe that their cloud platform will also expand a heavy amount, and I still think their core retail business, like the Amazon side of things, will just explode over the future as well, and it already has exploded. And I mean, they have so many different integrated apps that I think that Alibaba will just be, it's just undervalued at these prices. Like, just that's it. And like Charlie Munger, he's been buying the dip. His average cost, I think, was at least for the past quarter, he bought at around $120 a share. Right now, the stock's at $103, but he also bought way when it was around $200 a share. My average cost is about, I think it was like $160 per share if you combine all my accounts. But yeah, I've kept adding my shares on the dip. So revenue was 38.6 billion US versus versus this much estimated a 10% year-over-year rise. So basically they missed on revenue, but they beat on earnings. So earnings per share was $2.65 US dollars versus $2.55. So they beat by 10 cents. As you can see here, they beat slightly here. A 23% year-on-year fall. Remember, they also had to pay a fine in 2021 of $2.1 billion, I believe, of like an anti-competitive or anti-monopolistic fine that the Chinese Communist Party imposed on Alibaba. So yeah, sure, it's their slowest growth, but I think they've had. I don't necessarily think it's increased competition. I think sure, maybe it's part of it is increased competition, but it's also mainly the general tech crackdown and rein-in of the Chinese Communist Party on the tech sector. So Chinese retail sales have been also kind of relatively slow. Retail sales remain sluggish in the fourth quarter of the year. And here is, retail sales missed expectations, growing by 1.7% in December from a year ago. Analyst report by Reuters expected a 3.7% increase. So that also probably hurt Alibaba's share. So the company's shares have fallen over 50% in the last year. Last year, Alibaba was hit with a 2.8 billion fine as part of an antitrust investigation. Our current share price does not fairly reflect the value of the company. This was the chief financial officer of Alibaba, and they bought back shares. They bought back 10.1 million of U.S. listed American Depository Shares, or ADS, for around 1.4 billion. And their share repurchase scheme will expire at the end of December 2022. So it's basically like giving a dividend. And I mean, with a company that's like $283 billion, buying back 1.4 billion of its shares in just one quarter, I mean, is pretty impressive. I think that amounts to about like a 5% dividend overall year over year. So I'm going to go over, of course, like the broad general strokes, and then I'm going to go in depth into their reports with their quarterly results right here. So yeah, so let's just get into it here. So investors watch for key metrics including customer management revenue, CMR, cloud computing, and the company's forward guidance. So they kind of broke down their core revenue streams, and it's China commerce business. Its single biggest portion of Alibaba's revenue came in at 100.09 billion won, which was a 1% year-over-year fall. However, they also increased their amount of consumers globally, which we'll look at. And honestly, I think it's just better to go straight into the report, to be honest. And I mean, I just want to say that, like, okay, so for their cloud computing, they grew by 20% year over year. Their key commerce platform grew only 7% year over year, but that made up for other segments. And I mean, again, of course, I'm not a financial advisor. Do your own due diligence, but I think this is an absolute steal. I also want to mention that, for example, Alibaba is a huge player. Like, it's. I don't think they can just be crushed easily, and if you have long-term sights in mind, I believe Alibaba will be a winner, okay? I mean, I've said this before, I'm saying this again, like this is my stock. And Alibaba, for example, was the first Olympic Winter Games to host its core systems on Alibaba Cloud. They also opened up other cloud and data centers in like Malaysia and Germany, for example. So this is a big company. So they have a multi-engine growth strategy. Again, they're not just focusing on one component, which I think is making them so successful. They're investing way more into new ventures as well as investing in their core businesses. And of course, it's been a complex and volatile market environment. I think that's an understatement. They achieved positive momentum. They reached 1.28 billion global annual active consumers. That's huge. That's basically like 1 in every 8 people bought something or did something related to Alibaba. That's huge. And there was a quarterly net add of 43 million consumers. Like that's growth right there, Like I think that's ridiculous. Growth of 43 million annual active consumers. Like I think that's freaking amazing. They wanted to reach carbon neutrality by 2030. ESG, environmental sustainability and governance regulations are like huge now. So they want to be carbon neutral by 2030, which I also think that's incredible. And I would love to support this. Again, 10% year over year growth. Sure, it was the slowest growth, but they're also priced in at a 14 PE ratio. So I mean, like I don't really care. 10% growth. I think they'll be able to grow more in the future, especially as headwinds ease. But again, this might take a lot of people in the comments are like, oh, like Alibaba, all your stocks are doing terrible. I'm not focused on what's happening a month from now. 6 months, even a year from now, I'm focused on what's going to happen to the share price 2 to 5 years out. All right. And if you have a long term perspective in mind, you can just keep buying the dip. And I mean, you'll look back, and 5 years from now, if the stock is, $400 plus, that's a 4x gain over 5 years. And I'm willing to wait that long for that kind of gain. But that's just me. Maybe you're not willing to do that, but I think I'll be rewarded. So revenue was 38 billion, increased 10%. So China commerce segment that's their key thing here, was 27 billion. That increased only 7% year over year. But we have seen, like, again, a slowdown in retail sales, which of course this 7% increase reflected that. However, their cloud segment increased by 3 billion. Local consumer segment increased by 27% to 1.9 billion, and international segment increased by 18% to 2.5 billion. So I'm really excited with the cloud segment of 3 billion here. I think that this will continue to grow. Part of the reason why I expected it was 33% growth last year, but it's only 20% growth this year. Part of the reason is because TikTok, their main servers, went off of Alibaba Cloud, so that hurt their business. But they're expanding, and they're always adapting, and that's what I like about Alibaba. They're always adapting to new environmental and kind of like new business partners, new regulations, etc. So 979 million consumers in China, 301 million consumers overseas. I also bought stuff from Alibaba. I bought fake AirPods, which I made a video about, which were pretty good. And I mean, it's a pretty sticky platform. You look at anything related to commerce, like Amazon and drop shipping, people buy from China, from Alibaba, and then they go and put that product onto Shopify, and they deliver that to American consumers. Like, that's like drop shipping right there. And I'm even thinking of starting my own business like that. So like Alibaba makes all of this possible, basically. So this was growth, quarterly net increase of 26 million in China and 16 million overseas. But when you look, they had 979 million, so they increased by 26 million in China and 16 million users in overseas. And when you actually do the math, that's a more of an increase in overseas, like international customers, relative to China customers. So I think that's like super, super exciting. Income from operations was 1.1 billion, a decrease of 86%. That's because they had to basically shell out close to 4 billion impairment of goodwill in relation to digital media and entertainment segment. But excluding this, they would have been 5.5 billion, which is still a decrease of 30% year over year, which was primarily due, and you have to look at the negative components as well, and here it is: our increased investments in growth initiatives and our increased spending for user growth, as well as our support to merchants. So I mean, I think that's like reasonable. Okay, sure, they decreased growth, but they're taking that money, they're not only buying back their shares, but they're investing into more growth, which I think I fully support. I'd rather them invest in their company so that they're way more strong 10 years out than basically giving back the money and kind of being slower growth in the forms of dividends, maybe, just because I have a long-term perspective in mind. But again, they did have impairment of goodwill of 3.9 billion in relation to the digital media and entertainment segment. So maybe some poor decisions on management made there. So you can look at this here, but basically you look at China commerce only grew 7% year over year. But so that is concerning, and I think that's what Wall Street didn't like. But they still have, I don't know, I still think it's a revenue beast, and I mean, they will, like, they're hurting now, but again, I do think they will come up strong. International commerce, they had Lazada, AliExpress, grew strongly and achieved about 301 million active annual customers in the 12 months ended December 31st, 2021, resulting in a net increase of 16 million. So the combined order growth of these businesses was around 25%. And you can see individually, orders for AliExpress Europe due to value-added tax levied across border parcels below 20%, 22 euros in value. So international commerce increased. Local consumer services, again, like they're just like experimenting with different ways of delivering parcels, different fulfillment centers. They talk about their cloud. They talk about Kayano, before inter-segment elimination, whatever, blah blah blah. Global infrastructure, strengthening its end-to-end logistics. So this is their logistics component. And again, we've seen what the supply chains have done. That's also hurting the Alibaba segment. But again, they're not trying to make excuses here. They're trying to see in ways in which they can be better and do better and follow the regulations while still growing. And so that's what I like about Alibaba. And of course, logistics kind of took a hit, I believe, but they still grew 15% year over year. Let's see, data centers. Alibaba Cloud continues to ramp up its international presence and has added 2 data centers in South Korea and the other in Thailand. Alibaba Cloud offers computing services in 25 regions globally, including Malaysia, Singapore, Indonesia, Japan, Germany, and Dubai. Like, come on, like, are you kidding me? You know, they're more than the Amazon of China. They're like the everything of everything, you know, like, oof. Yeah, and one last thing I want to go for is the share repurchase program. So for the 9 months ended December 31st, we repurchased approximately 42.2 million of our American depository shares for approximately US 7.7 billion under our share repurchase program. So that's 7.7 billion over 3/4 of the year. That's not bad. That's basically like paying out a dividend to shareholders. And that represents 51% of their US 15 billion share repurchase program. So this expires December 2022. I don't know. That's when their current share repurchase program will expire. Probably they'll administer a new repurchase program after this one expires. So yeah, here you can see here 2020, 2021, just an increase of 10% revenue, which was 38 billion US dollars, and you can see right here 2.65 for the current quarter. And which is a 23% drop. Like, it is what it is. Sometimes you have to suffer before you see the gain, and I mean, especially in this market, I think that's hurting everyone. So yeah, and you can keep going through all of these revenues here. International commerce, like, it just keeps going on and on. So I mean, again, I think in a previous video I've showed my total shares, my average cost in Alibaba. I believe one was around $260 or $240. That was my average price. And in my Wealthsimple, I have about the same amount of shares, and with an average cost of, I believe, around $150. So I'm sitting at a loss of Alibaba. I mean, this is a stock that's right now $103.57. But I'll be holding for the long term. That's just kind of the shareholder I am. Let me know what your thoughts. I'd appreciate if you give this video a thumbs up and subscribe to my channel. I've just been trying to be super candid about my investments, and I'd appreciate some support. Also, check out the link down below to the free Discord, and if you'd like to support me on Patreon. And anyways, peace out, guys. Love you all, and I'll see you in the next one. So yeah, take care, everyone.